Let me ask you a simple question. If you found out that a technical analyst with 50 years of experience, someone who called the 1987 stock market crash before it happened, who told clients to get into silver when it was still at $40, and who has been publicly on record with $300 to $500 silver targets for this year, just identified one specific price level where everything either breaks out or breaks down for silver. Would you want to know what that level is? Of course you would. That number is $80. Not $80 just as a round number. Not $80 because it sounds clean. $80 on a weekly close because that is the exact point where three separate technical structures, built independently, measuring different things, simultaneously flip from bearish to bullish at the same price. We are sitting right now, as you watch this video, at roughly $73 to $74 on silver. That is about $7 away. Less than 10% from a level that one of the most respected independent analysts alive is calling the most structurally bullish setup he has seen in years. And here is the thing nobody's talking about. Something already shifted underneath the surface last week. A signal that most investors completely missed because it shows up on a momentum chart, not the price chart they are staring at. By the end of this video, you are going to understand exactly what that signal is, why $80 is the line in the sand, and what happens to silver if it clears that level on a weekly close. Stay with me. Everything starts here. Before we go further, this is not financial advice. Nothing in this video is a recommendation to buy, sell, or hold any asset. Silver is a volatile commodity. It can move against you sharply and quickly. Please consult a qualified financial professional before making any investment decisions. What we do here is look at the data, the analysis, and the structure of the market clearly, without the hype and without the fear. Whether you're watching from the United States, India, Germany, Nigeria, Brazil, or anywhere else, this breakdown is for you. If this is your first time here, subscribe and hit the bell. This is a channel that respects your intelligence. Now, let's get into it. Let's start with who is making this call, because not every technical forecast deserves your time. Michael Oliver is the founder of Momentum Structural Analysis, or MSA. He entered the financial industry in 1975, before most people watching this video were born, joining E.F. Hutton's International Commodity Division in New York, working under the chairman of the COMEX itself. Through the 1980s, Oliver developed something different. He noticed that looking at price charts alone left too many unanswered questions, too many false signals, too many moments where a chart looked fine and then the market collapsed, or looked terrible and then exploded higher. So he built his own framework. He takes price and converts it into momentum. He creates an oscillator, a chart of where price sits in relation to a given average. And that oscillator has the same technical structures as a price chart. Uptrends, downtrends, breakouts, breakdowns. The critical insight is this: almost always, momentum breaks before price does. The underlying force of a market turns first. Price catches up later. The Wall Street Journal described his method in 2015 as tracking momentum to reveal trends that have been building for a long time with much more depth and staying power. His track record on major calls is genuinely respected. He called the 1987 crash, technically. He identified copper's structural breakout in 2003. The metal went from under $1 to over $4 by 2011. When silver was still at $40, his models pointed toward $100. He was right. His publicly stated targets for silver in 2026, based on the same momentum framework, are $300 to $500 per ounce. We will walk through the logic behind those numbers later in this video. But right now, his most immediate and actionable call is this: $80 on a weekly close is the trigger that confirms silver's next major upside leg is structurally engaged. Let me explain exactly what that means, and why three completely independent technical structures all land at the same number. Understanding why $80 is not random. When technical analysts identify a breakout level, they often do it based on one thing: a trend line they drew, a moving average that happens to sit at a certain price, a round number that feels important. What Oliver is describing is different. He has three completely separate measurements, three different ways of analyzing the market, all converging at the same approximate price zone. Let me walk through each one. Convergence. Number one, the weekly momentum oscillator. Silver has been forming a pattern since January's all-time high of $121. On the weekly momentum chart, not the price chart, the momentum chart, silver has been making lower highs and lower lows. A downward staircase of momentum. Every bounce produced a lower peak on the oscillator. Every pullback set a new lower trough. To break that pattern, the momentum oscillator needs to close above a specific level on a Friday. That level, adjusting slightly week by week, sits in the $80 to $81 zone. A weekly close above that level breaks the descending momentum pattern that has governed this entire correction. The first convergence point, around $80. Convergence number two, the 10-week average oscillator. Oliver tracks what he calls a sister indicator, a 10-week average oscillator that functions similarly to a 50-day moving average, but applied to his momentum framework. Right now, a weekly close at 80.50 or higher shifts this indicator into positive territory. Two completely different measurements of momentum, the oscillator and its average, both triggering positive at approximately the same price. The second convergence point, still around $80. Convergence number 3, the price. Downtrend itself. Now look at this simple price chart. From silver's peak weekly closes since January, you can draw a downtrend line through the sequence of lower highs. That line, over the next several trading weeks, passes through approximately $80. A weekly close above $80 pushes silver above that trend line for the first time since the January peak. 3 measurements, 3 separate methodologies, 3 different things being analyzed, all producing the same approximate trigger, $80 on a weekly close. And right now, as of May 6th, silver is sitting at approximately $73 to $74. That is about $6 to $7 away from that trigger, less than 10%. Remember, at the very beginning of this video, I told you something already shifted underneath the surface last week. Here's what I was referring to. Cast your mind back to late March. Silver had just hit a brutal low, briefly touching $61 in mid-March before staging a sharp reversal within hours. From that low, silver bounced. And when it bounced, the momentum oscillator did something that had not happened since the January peak. It cleared a multi-point downtrend on the momentum chart. Not the price chart, the momentum chart. The underlying force of the market broke its own downtrend before price confirmed anything. That is the early warning signal Oliver's framework is designed to catch. That single shift in late March is what produced the recovery from the $61 low back up towards $76 to $80 range over the following weeks. Momentum broke its downtrend first. Price followed. Then last week, a second signal appeared. The momentum oscillator made a higher low for the first time since the January peak. In a pattern of lower highs and lower lows, a higher low is the first structural break. It does not confirm the reversal yet, but it is the first footprint. So we are now looking at 2 distinct positive shifts in Oliver's framework. One in late March, one last week. 2 layers of the same technical reversal, stacked on top of each other, visible right now to anyone who looks beyond the daily price chart. Oliver's exact language on this. It is a positive indication that has already triggered. Read that carefully. This is not waiting for a future event. Part of the technical reversal has already happened. The momentum structure is already in early breakout mode. What it needs now is confirmation at the price level. A weekly close above $80 formalizes what the momentum picture has already begun showing. The $70, $80 range and what is holding silver. Now let me give you the ground level reality as of today, May 5th, 2026. Silver is trading at approximately $73.80. It rose 1.51% today, which is encouraging, but it is fighting significant headwinds. According to the data from Trading Economics, silver is down about 20% since the current Middle East conflict began in late February. The Strait of Hormuz situation, now in its 10th week, has been the dominant suppressive force. Here's how that chain of events has worked against silver. The conflict drove oil from roughly $70 to $75 per barrel toward peaks, near 113 to 115s. That oil spike pushed inflation expectations sharply higher. The Federal Reserve, facing above target inflation driven by energy prices, cannot cut rates. High rates make yield-bearing bonds more attractive relative to silver, which pays nothing. Capital moves toward bonds. Silver's paper price falls. A strong dollar compounds it further. High U.S. rates attract global capital into the dollar. A stronger dollar makes silver, priced in dollars, more expensive for international buyers. Demand from Europe, Asia, and the rest of the world softens. Price falls further. That is the full suppression chain. And notice every single link in it is tied back to one geopolitical event, the Strait of Hormuz, the Hormuz conflict. Technically, analysts at FX Daily Report and Investing.com both confirm the picture. Silver is currently locked in a $70 to $80 trading range. The $70 level is downside support that is held multiple times. The $80 level is the resistance ceiling. The market is in consolidation, waiting for a breakout. A few things shifted this week that are worth watching closely. First, Iran sent a revised peace proposal. There are early diplomatic signals, cautious, fragile, not confirmed, but they exist. President Trump announced plans to restore shipping through the strait by escorting civilian vessels with U.S. naval ships. Iran immediately warned it would respond. So the situation is still actively evolving. Second, there's a critical data release on May 12th, 1 week away. The April CPI reading. If April's consumer price index comes in below 3%, showing that the energy inflation component is finally starting to ease. That shifts the entire Federal Reserve narrative, from rates on hold indefinitely to rate cuts possible in the second half of 2026. Silver would respond immediately. Third, Kevin Warsh is expected to be confirmed as the new Federal Reserve Chair. Markets believe he leans more open on the growth side of the Fed's mandate. His first press conference as chair will be one of the most important monetary policy events of the year for precious metals. The technical picture and the macro situation are both pointing toward the same conclusion. A decision point is coming, and $80 is where that decision gets made. The mechanics of a confirmed breakout. Let's talk about the mechanics of what actually happens when a major asset breaks out of a months-long consolidation pattern at a level where multiple technical systems simultaneously flip positive. The first thing that happens is stop losses trigger. Every trader who has been positioned short on the descending pattern, betting silver stays weak, suddenly has losing trades. Those positions get closed. That means buying, forced buying, regardless of anyone's opinion on where silver should be. The second thing that happens is algorithmic reallocation. Algorithmic trading systems, which represent a large and growing share of total market volume across all asset classes, are reading technical signals constantly. When multiple indicators simultaneously shift positive at the same price, those systems shift their allocation toward the new trend signal: more buying. The third thing is fundamental investors who have been waiting for technical confirmation finally enter. There are a lot of people who believe in the silver story, the supply deficit, the industrial demand, the monetary backdrop, but who have been sitting on the sidelines waiting for the chart to confirm the thesis. A weekly close above $80 is that confirmation. All three of those things happening simultaneously is why breakouts from multi-month consolidation patterns are rarely gradual. They tend to be sharp. Silver does not drift from $80 to $85 over several months. It tends to move in bursts, fast moves that catch most people either underpositioned or on the wrong side. Oliver's analysis does not exist in a vacuum. The broader institutional picture supports the direction. Bank of America has published a bull scenario extending to $309 per ounce. Citi has issued a target of $110 for the second half of 2026, citing acute shortage of physical silver available for immediate industrial delivery. Goldman Sachs expects silver to average $85 to $100 per ounce this year. JP Morgan projects an average of around $81 per ounce for 2026. Commerzbank and Deutsche Bank have both cited $90 to $100 as realistic year-end targets. The LBMA, the London Bullion Market Association, whose member analyst survey represents the most direct institutional consensus on precious metals, has a 2026 average silver price forecast above current levels. These forecasts were made before the current Strait of Hormuz suppression. They represent the view of what silver does when the temporary macro headwind lifts. Understanding Oliver's longer framework, I want to address the $300 to $500 target directly, because the way these numbers usually get presented does them a disservice. They either get dismissed as fantasy or they get promoted as certainty. Neither of those responses is accurate. Here is where those numbers come from in Oliver's framework. Oliver describes what happens after a major long-term resistance level breaks as what he calls lightning form repricing. For roughly 5 decades, in 1980 and again in 2011, silver approached $50, only to be turned back each time. That level became almost mythological. It held for over 40 years. In January 2026, silver hit $121. The $50 ceiling is now well behind the market. According to Oliver's framework, once a multi-decade resistance breaks definitively, the repricing that follows is violent and rapid, correcting where the asset should have been trading all along had the structural suppression not been in place. He estimates that if silver's relationship to gold, what's called the gold-silver ratio, moves from its current level of roughly 62 to 1 toward historically more compressed levels, the math produces very large numbers. Today, gold is trading near $4,500 to $4,600 per ounce. The gold-silver ratio sits at approximately 61 to 62 to 1. In 1980, at the peak of the last great silver bull market, that ratio compressed to 17 to 1. At 2011's silver peak, it compressed to 32 to 1. If gold holds at $5,000 and the ratio compresses to 30 to 1 pause, not even close to the 1980 extreme, silver would be at $167. At 20 to 1, silver would be at $250. At 15 to 1, which is closer to the geological ratio of silver to gold in the Earth's crust, silver would be above $300. Those are not predictions. They are mathematical outputs of specific ratio scenarios applied to a specific gold price. Whether those scenarios materialize depends on whether the 3 conditions Oliver identifies: currency debasement at scale, mine supply that cannot catch up, and industrial demand that accelerates. All converge simultaneously. The important thing to understand is that two of those three conditions, the mine supply constraints and the sixth consecutive year of structural supply deficit, are already confirmed facts, not possibilities. The Silver Institute projects a 67 million ounce shortfall in 2026. China's silver imports reached their highest level in 8 years in early 2026. Physical investment demand is forecast to jump 20% to 227 million ounces this year, a 3-year high. The $300 to $500 framework is not random extrapolation. It is the logical output of conditions that, in various combinations, have precedent in this market's history. Whether you believe in the timeline or not, understanding where those numbers come from is more useful than either dismissing them or accepting them uncritically. 5 things to track, in order of importance. Number 1, the Friday weekly close on silver. This is the only data point that actually confirms or denies Oliver's breakout signal. Daily intraweek moves above $80 mean nothing. A Friday close above $80 means everything. Check silver every Friday evening. That is your confirmation signal. Number 2, the May 12th CPI report. The April Consumer Price Index prints 1 week from today. If it comes in below 3%, showing that the energy inflation component from the oil spike is starting to ease, that reopens the door to Federal Reserve rate cuts. Silver is extraordinarily sensitive to rate cut expectations right now because the high rate environment is the primary paper market suppressor. One soft CPI print does not end the conversation, but it begins it. Number 3, oil, Brent crude. Oil is the master variable. Everything else adjusts around it. Watch Brent crude before you watch silver. Below $95 is modestly positive for silver. Below $90 is meaningfully positive. It changes the inflation math. Above $105 is negative pressure. Above $110 is serious headwind. The daily oil price tells you which direction the macro wind is blowing. Number 4, any formal statement on the Strait of Hormuz. Watch the language from the White House on Iran's revised proposal. Words like framework or exploring talks signal potential engagement and will ease oil prices. Words like unacceptable or no negotiations signal continuation of the conflict and oil stays elevated. Either set of words moves oil, oil moves silver. Number 5, volume on any push. Toward $80, if silver approaches $80 on rising volume, meaning more trading activity, more institutional involvement, the probability of a genuine breakout increases significantly. If it approaches $80 on falling volume, it is more likely a failed test. Volume tells you whether there is real conviction behind the move. The 3 scenarios that are actually possible. Scenario 1, silver breaks above $80 on a weekly close in the next 2 to 4 weeks. The technical confluence triggers. Short positions cover. Algorithmic systems reallocate. Fundamentally driven buyers who were waiting for confirmation enter. Silver makes a fast move toward $85 to $95. This is what all the data structures are pointing toward. But nothing is guaranteed. Scenario 2, silver continues to build a base in the $70 to $80 range for several more weeks. Frustrating for holders. But historically, extended base building periods at the bottom of a correction are exactly where the most powerful moves originate. Maximum frustration precedes maximum opportunity more often than not. Scenario 3, the Strait situation escalates further, oil respikes above $110, and silver breaks below $70 toward the $63 to $65 zone. Painful. But even at $65, silver would still be within the historical range of a normal correction inside a confirmed bull market. The technical thesis would require reassessment at a weekly close below $70, but not necessarily abandonment. Let me close with something simple. Silver is sitting at roughly $73 right now. 3 months ago, it was at $121. 5 years ago, it was at $12. The ride has been extraordinary, painful, confusing, and for a lot of people, deeply frustrating. But here is what has not changed through all of that. The world is consuming more silver than it produces for the 6th consecutive year. The mines cannot be built fast enough to close the gap, not before 2033 at the earliest. The industry is consuming silver, solar, electric vehicles, artificial intelligence infrastructure, semiconductors, are not cyclical side stories. They are being built into the foundation of the global economy. And a 50-year veteran of the futures markets, whose track record on major market calls spans multiple decades, just identified a specific, precise, technically grounded level, $80 on a weekly close, where the pattern that has held silver down for 3 months finally breaks. You will look back at this week, silver in the low 70s, 10 weeks into a conflict that has suppressed the price through the monetary policy channel, with the actual breakout trigger less than 10% away. And it will either be clear that you understood what was happening, or it will not. The information was here. The analysis was clear. What you do with it is your decision. If this breakdown gave you a clearer picture of what is actually going on in this market, share it with one person right now. Not for my benefit, for theirs. They might be sitting on a position they do not fully understand. This video might help them. Drop your answer in the comments. Are you watching the $80 level? Are you positioned for the breakout, holding and waiting, or standing aside until you see the weekly close above $80?